Good morning, everybody. Just a quick intro to the quant research team at RavenPack. We basically sit as an internal client, so we receive the news analytics data as our clients would receive it. And we then try to come up with ideas on how you can apply that data to predict stock prices or currencies or commodities and so on. And hopefully, based on our work, we're able to inspire people on how to use our data in their own investment framework. So this is basically the agenda of my talk today. I'm going to go through first some of the key features that makes up a news analytics data set, just so you kind of get an example of what it is that we're actually talking about here. And I'm also going to spend a little bit of time on introducing the RavenPack event taxonomy, which is one of the key features of our data set. And it's something that we leverage quite a lot as part of our own research. I'm then going to move on to a simple case study where we try to come up with a very simple way of can you say, trading the event level information. And then for the rest of the presentation, I'm going to focus on the indicators that were made available today through the FactSet platform. So basically looking at RavenPack equity indicators. And I'm going to focus on 3 use cases. I'm going to look at them as a standalone indicator. So basically just looking at the sentiment indicator, ranking a universe of stocks and just forming long-short portfolios based on going long the top 10% of stocks according to sentiment and short the bottom 10%. And then we're going to apply it as a filter on more traditional factors. And in this particular case, I'm focusing on filtering momentum. And then finally, I'm going to present a case study where we have used both the sentiment indicators as well as the news volume-based indicators to forecast volatility. So this is basically what our data set looks like, or some of the key features. The granular news analytics data set that we provide contains about 40 columns on the equity side, and 30 columns on the macro side. So basically, we have 2 packages in place, and one is obviously what we call the equity product, the other one the global macro product. This is an example of the equities data. So and what distinguishes the 2 is that in the equities package, the entities we detect are companies, where in the global macro side, it's places, organizations, and currencies and commodities. So what are the key attributes? Well, the first attribute is obviously entities. So in order to make sense of any other extracted information from the news, you obviously need to be able to link it to some sort of entity. And we produce for every news story, for every entity mentioned in the news story, we produce an individual record. So if 3 companies are mentioned in the news, there will be 3 records for that news story. And we basically allow you to easily map that via QSIPs, ITINs, or CEDOs to your own trading universe. Our entity detection, I have to say, is point-in-time sensitive, in that we model M&A activity. So Gillette points to the Gillette up until the point they got acquired by Procter & Gamble, after which Gillette is considered a brand name. So whenever you see more news coming for Gillette, it will from then on point to Procter & Gamble. So, and that obviously is important if you want to backtest on this type of data. We offer data back to 2000 on the Dow Jones edition. Obviously M&A is very important there. Or sorry, point-in-time sensitivity is very important. The second attribute is relevance. And this is not about whether it will move the stock price or not. It's more related to how pertinent is the entity in the news story. So is it relevant to that company or not? It may be that there were 5 companies mentioned in the same news story, but it's not necessarily equally relevant to all of them. It's a relatively advanced, or quite advanced, can you say, analytic. We not only look at information such as positioning and the frequency of mentions of a given company, for instance, but we also look at the roles that they may play in an event. So for instance, if we identify a company playing a target role in an event, it will get a relevance score of 100, which is the highest level of relevance. So for instance, if we take the example of Goldman Sachs upgrading IBM, even though they're both mentioned in the headline, IBM will get a relevance score of 100, and in this case, Goldman will only get a relevance score of 20 because we identify it as a rator. So that's a very useful analytic in terms of getting rid of potential noise. If you want to construct signals from this data, it's definitely one of the key dimensions to focus on. The third and fourth attributes are events and sentiment, where sentiment gives you a sense of direction and potential strength of a given event. The event information itself is also very important because it allows you to form opinions about how quickly potentially a signal may decay. So if you have a sentiment score of 76, should you trade that 76 over a 1-day or 10-day horizon? That information is not really contained in the sentiment score, but you can extract that type of information from the event category itself, using it as for conditioning purposes. And you may also say that for my particular strategy, I don't want to trade these type of events, and I just want to focus on this. So for instance, we saw in the Rubini example where they focus on political risk, they are filtering basically and only selecting those event categories or event groups that are interesting to their for their problem. And finally, we also look at something we call novelty, and that basically focus on, is this the first time you have seen this news event for that stock, or have you seen it before? Is there focus, a lot of focus or attention given to this stock right now? So you can start to kind of get those type of opinions. So you could either use it as a filter saying I only want to trade on the most novel news, or I want to trade on or see what kind of information builds up a buzz and creates a theme for a given company. So those are the 5 key attributes. And having covered, can you say those, I'm just quickly going to present a little bit on the event taxonomy. So RavenPack covers more than 2,000 different types of events in the news, market-moving events. And of course, it's not necessarily always you want to work at the the most granular level. And in many cases, in our research, we end up aggregating the different events into broader groups. So we often work at the 51 group level to kind of get opinions about, what are the themes driving companies. Does a company have a bankruptcy theme right now? Does it have does an economy have a civil unrest theme right now? Or a war and conflict theme. These are quite interesting ways of looking at the data, and you can roll it up in whatever level of that you want to work with in the event taxonomy tree. And also at the very top level, we have the 5 different topics for one covering business, economy, politics, society, and environment. And I think that's very important for the different aspects of analysis you want to do. For instance, we tend to find that if you're interested in trading interest rates or currencies, you may want to focus more on economic news, where if you want to trade equities, news about companies are more important. So, but you can start to look at the different weights that these dimensions should have in your model and work up and down this event taxonomy. So having kind of seen how this works, let's try and jump into a very simple event study, just focusing on a couple of groups. I've selected 3 just to show you how it can drive equities prices. So first we'll focus on the Russell 3000 universe. We group our universe into companies that have had news in a given event group. So the 51 group level, that's the second layer of your event taxonomy, or our event taxonomy. So we look at companies that have had news in a particular event group on a given day. And we then split those companies within a given group into companies that have had positive news, negative news, and neutral news. And then see how prices move for those stocks. We basically aggregated over a 24-hour window. And we cut it 30 minutes before market close in the US, and then look back 24 hours. And that's, if you have had news over the last 24 hours, you're considered part of that event group for that day, right? So we basically look at two things. We look at an explanatory return and a predictive return. So the explanatory, we assume that you can trade on the close, and the explanatory return is basically looking at the close today versus the close of yesterday. And the predictive return is looking at the close today and against the close of tomorrow. Of course, it may be that some of the explanatory return you would have captured had you been able to not move in necessarily at the close, but closer to the event itself. But we put everything into the bucket of the explanatory return, right? And this is basically just to get a feel for or an understanding of the different reactions you might see across positive news, negative news, and across event categories. You may see that some groups, in the lack of a better word, are momentum driven. So they will follow sentiment also beyond the intraday horizon, where others might typically revert. So you may have seen an initial overreaction to the different events. So let's try and look at a few examples. So this is, can you say, a quite traditional event group. We cover both scheduled and unscheduled news, and also, of course, some of the more traditional things. You have a lot of analyst ratings in the news, a lot of earnings stuff, but there's also a lot of other interesting type of information you can extract or work on with our different events. So in this case, I just looked at analyst ratings. The top bar chart basically looks at the explanatory return, and the bottom bar chart looks at the predictive return. So as you can see here, companies that are generally considered having positive analyst ratings do outperform on an explanatory scale. And companies with negative analyst ratings typically underperform. If you look at the predictive return, you still see an outperformance for positive sentiment stocks in the next day. And you see a continued underperformance for negative stocks. So this basic analyst ratings tends to have this kind of momentum-driven effect on stock prices over the following day. And this is basically the cumulative return profile you would have seen had you traded those different companies that had positive and negative analyst recommendations on it. And as you can see, it's been pretty consistent over time. If we look at another example of assets, we have a group called assets, and that contains both when companies open or close facilities, have news about patents, theft, or vandalism. Again, we see from the explanatory return that positive sentiment stocks outperform negative sentiment stocks. You still see that on the predictive side, but what you also see is that actually the positive sentiment stocks tends to or seem to go through some sort of reversal. So there's been an initial overreaction intraday, and then you actually see it doing slightly worse or kind of pulling back the following day. So how you should end up trading the different events or the different sentiments also depends on the event category that you look at. And you can also, again, see that's been pretty consistent over time. There are a lot fewer events here than in the previous example, so there's more volatility around your return profiles. And finally, we can look at products and services. Similar thing, intraday positive sentiment stocks outperform negative sentiment stocks. And as looking at it from a predictive point of view, there's still a lot of value left for negative sentiment, but there's really nothing left for positive sentiment stocks. And this is kind of what it looks like from a cumulative return point of view. So not all our clients are consuming our data and are interested in looking at it from an event-driven point of view. Some people are just interested in getting, what's the sentiment overall for IBM today, and then make decisions based on that. And that's really where the RavenPack equity indicators come into play. And here's an overview of what that data set looks like. We have basically two different dimensions in that data set. There's a sentiment dimension, which is kind of this positive or negative sentiment. It's a score between -1 and 1. And then we also have a set of volume-driven scores. So that will give you information about how much news have you had that supported that sentiment direction? And we also include a set of what we call abnormal volume scores. So you basically say, do you have abnormal news for that company or not? So for instance, a company like Apple will obviously have more news about them than some small cap company. So you basically have to look at it in perspective. So it may not be particularly abnormal that Apple has 100 news items, but if it suddenly spikes to 500, something interesting might be going on around Apple. So that's kind of what we try to capture there. And there's a lot of people are using that, for instance, for volatility prediction. And also just generally to support the sentiment direction. So that's kind of what that RavenPack equities indicator product looks like. We have a set of 3-month aggregated indicators where we have applied a sentiment decay function and a time weight function to them, such that, of course, news that occurs today is more important than news that occurred 3 months ago. And also, the time weight function incorporates an asymmetry in that we decay sentiment faster for companies that have lots of news as compared to companies that have little news. And we see that also being an empirical fact, or stylized fact, when you start to look at how quickly is news incorporated into stock prices. So that's basically what we look at. We also have a set of one-day indicators such that you can create your own aggregates and smooth the indicators as you please, depending on what it is that you want to achieve with them. And similar to the granular data, you can map the different indicators using QSIP, ISINs, or CEDOs, and tickers as well. And obviously through the FactSet platform, everything is pre-mapped. So this is basically the performance that you see going long the top 10% of stocks and short the bottom 10% of stocks according to our one-day sentiment indicator. The green line is the Russell 3000, and the red line is the Russell Europe Index. One-day investment horizon. There's no transaction cost. And as you can see, they have worked pretty well and quite consistently over time. And if we apply, 10 basis point transaction costs, we would have achieved information ratios of about 175 for the EU and around 190 for the US. But what you will also notice is that these type of daily signals have very high turnover. So it's not for everybody. We are in like 95% daily turnover, which is obviously quite high. So one way of potentially addressing the turnover is, of course, to smooth your indicator further. And that's basically what we do on the following slide. So here we take the other route, but it's kind of similar. So instead of smoothing the indicator, we just increase the investment horizons. So those are kind of the two approaches you can take. And from our research, we kind of find that you get very similar performance out. But we have Europe on the left side, and we have the US on the right-hand side. And as you can see, not surprisingly, at the very bottom here, as you increase your investment horizon to 5 days, 10 days, 21 days, and 63 days, this is in business days, by the way, you see that the turnover comes down quite substantially. But of course, you also get a slightly reduced information ratio. Still for Europe, you're able to achieve information ratios above 1. In fact, you get about 1.3 for the monthly window investment horizon. While for the US, you get below an information ratio of 1 as you go beyond a couple of weeks investment horizon. But you still stay positive even 3 months out. So that's an example where we just took the indicator as a standalone. But as I mentioned, it is, news-based signals tend to have relatively high turnover if you look at it from a standalone perspective. And that can be challenging to some investors. And we did show one example of how you could address that by just increasing the investment horizon or smoothing your indicator further. But another way of doing it is also to potentially apply it as an overlay to existing factors. Such that you keep a better handle of the turnover, because it's the factor itself that will kind of drive the turnover statistics of your enhanced indicator. In this particular example that I will show you now, we are focused on momentum. So trying to filter momentum with sentiment. We consider, again, the Russell 3000 and the Russell Europe universes. We first of all create a standard momentum signal. So we basically add or apply different formation periods from 1 month to 18 months. And then according to the literature, we remove the first month return from all the different windows, except for, of course, the 1 month formation. We just keep it as it is. And then we create a benchmark first saying, okay, we could filter momentum by momentum itself. So having, let's say, a 12-month momentum and then filter it by a shorter momentum filter, so a faster momentum signal. And we do that as a benchmark. And then after that, we filter it by sentiment. This is the heat map we get across the different formation periods for the US. So the top part is momentum-filtered momentum, and the bottom part is sentiment-filtered momentum. And what's quite striking is that the green bars is obviously where you see the highest information ratios in this case. All of these are basically, we have just, it's a heat map across information ratios of that strategy. And what we find is that most of the green parts tends to be in the sentiment-filtered momentum area. So it looks to be that it looks as if the sentiment-filtered strategies, first of all, sentiment adds value, and secondly, it's more consistent across the different formation periods as compared to momentum. And you get higher information ratio out of it. In fact, the highest information ratio we get for a sentiment-filtered momentum strategy is slightly above 1, which is about twice as high as the highest we get from a momentum-filtered momentum strategy. So that's quite interesting, I think. And generally, we find that the best filter to apply on momentum is a relatively short sentiment filter. So in this case, you can see the first column is basically aggregating sentiment over 1 month. And that provides you the best results. But you also still get some pretty good results out, even though you actually aggregate sentiment, let's say, over a 1-year period, which is further to the right-hand side. We did the same for Europe, similar result. Again, we find that sentiment is a stronger filter than momentum. We do find, however, that the filter you want to apply or the formation period you want to apply on your sentiment filter is longer. So you have a slower moving filter. And again, we outperform the highest information ratio you would have achieved with just filtering momentum by momentum. Interestingly, we find both for Europe and for the US that the best formation period for momentum itself, the core signal, is about six months. And then, in both cases. So this is another way of looking at it, actually. And here we have taken the black line. The top is the US, the bottom is Europe. The black line here is momentum itself, the unfiltered momentum signal, and then looking at what information ratio do we get for the different formation periods. The green line is when we focus on just one column of that heat map. And we take the column that contains the highest information ratio for either sentiment or for sentiment, sorry. So on the top one, we focus on the 1 month sentiment filter, and in the bottom one, we focus on 13 month, I think it is, as a filter. The red line is the momentum versus momentum, or the momentum filtered momentum. But the red line, we have applied a level of severe overfitting. So we haven't taken the best column, we have taken the best cell across everything. So we basically we take the highest information ratio that you would have achieved with a momentum filtered momentum for any formation period of the momentum signal itself, right? So we are actually favoring the momentum filtered momentum quite heavily here, right? And still in the US, we're able to outperform with the sentiment-based filter, both in the US and in Europe. But we kind of are very much in line with the momentum-filtered momentum if you go beyond formation periods for momentum itself of more than 10 months. But again, as I mentioned, the red line has been severely favored here, right? So sentiment is generally more consistent. The last use case that I'm going to talk about is something we have done together with an external party, Anish Shah, who's looking at, he's basically using our data or our indicators to predict volatilities, and there will be a paper coming out on this eventually. But this is, I've just taken some of the preliminary results from the study. And his company is called Investment Grade Modeling for information. And basically the idea here is to differentiate a universe of stocks, again, the Russell 3000, and see if we can use sentiment and news volumes to enhance his volatility forecasts. His benchmark model, or reference models, he looks at two different ones. One basically just considers a weighted sum of volatilities, and he looks at intraday high lows as his volatility measure. So he looks at volatility over 5-day, 10-day, 21 days, 63 days, and 126 days. And then he combines them using some cross-sectional regression model and say, that's my volatility score for that company. He then had another reference model where he adds an extra component where he allows the industry volatility also to impact the volatility of your stock. So that's benchmark model number 2. He then tests that to see how it has worked historically. So looking back to 2000, mid-2000 till mid-2014, and finds that there is a correlation between his forecast and his realized volatilities of about 80%, depending on your forecast horizon, and he looks at 1 week up to 6 months. So taking those two benchmark models, he says, okay, can we apply sentiment and media attention and improve on these forecasts? And basically, he adds these indicators, snapshots, after he basically takes a snapshot after market close, and he basically just adds them as extra terms in that cross-sectional regression model. And to mimic the same kind of setup as you had in reference model 1, he also applies he adds, can you say, the mean, an extra term that looks at companies in the same industry. So he takes just the top 5 companies in the industry and take the mean across those and have that as an input to the model as well, in order to try and capture these contagion effects that you might have within a given sector or industry. And this is basically the result that he gets. And he basically, the left-hand side, he kind of compares all the different indicators or versions or predictions against his model 1, his simple reference model. And on the right-hand side, he compares the forecast with his more advanced reference model. And what you can see here is, and I will tell you how to interpret it. So basically, if you look at the orange and the yellow lines, these are the news-based or news-enhanced models. And basically, it says here that if you look at the 1 week example, that in 75% of cases, does the news-enhanced model outperform benchmark or reference model number 1. So looking across the different horizons, we can see that the news-enhanced models are better in between 60 and 80% of the times. It will have a higher correlation between the forecast and the realized. In comparison to the more advanced reference model, again, we see that sentiment outperforms, or the news-based forecast outperforms, especially on the shorter horizons. If you move out to the 6-month horizon, they're kind of more in par with the advanced model, but on the shorter horizons, you still beat it with about 60 to or 55 to 65% of the times. So that's an example of how it could also be relevant to use sentiment and news volumes for volatility prediction. And just to summarize, I basically just showed what the granular news analytics data look like and how you can take advantage of our event taxonomy and our sentiment scoring to trade market-moving events and considering price direction and signal decay and strength. We also showed how, or I also showed how the RavenPack indicators can be used for stock selection, as a standalone indicator, or to filter existing factors. And Macquarie has, as part of their research, shown that it's also valuable to use it as a filter on top of value and quality. And we also showed how you could use it potentially for volatility forecasting. And I think that's it for me. If you have any questions, I'm more than happy to take some.
We got time for maybe 1 or 2 questions. Hand me the mic. A little over time, but let's try one.
Peter, have you tested if there's any information value in a reversal, like if something was above 0.6 and went below 0.4 in a month, or vice versa?
We have done different reversal type strategies. We tend to look more in quantiles rather than exact cutoff levels. But we have found that as part of our research that you can enhance reversal strategies with news. So for instance, if sentiment moved against your price move, you're more likely to be a stronger reversal stock in the coming time period than had sentiment moved with you. We also find that generally if you had a price move that wasn't supported by news, you're also more likely, just news in general, you're also more likely to revert. So for instance, if you see a price move that wasn't driven by any fundamental changes in the stock, as compared to just being potentially moved by trading behavior, you're more likely to revert. That's at least the hypothesis there.
Okay, just one more question.
How does RavenPack News Analytics distinguish itself from its competitors? Because some of the competitors like Bloomberg and Reuters also give similar scores. So how do you distinguish yourself?
I would say one of the key features is our event detection capabilities, I think. And as I mentioned, we cover more than 2,000 different types of events. And I think it's quite important to be able to have that in place, as I mentioned, because sentiment only gives you a sense of potential direction. But events allow you to filter and focus on the things that you really care about. And also to get ideas about, you can get more information about how the price might behave after the event itself occurred, or that sentiment record. So you can have it feed into, over what horizon do I want to trade the stock? Do I want to trade it as a momentum or reversal and so on? Which is something you don't really get from sentiment. And most other suppliers of this type of information tend to have only the sentiment dimension, or if they have events, it comes as part of the editorial process. So it's not something which is automatically tagged.
Okay, thank you very much, Peter. Please feel free to reach out to him afterwards.